Everyone keeps asking me the same question. Why hasn't BlackRock launched an XRP spot ETF? Why is Larry Fink silent? Why won't Brad Garlinghouse say BlackRock's name in a direct sentence? And I have to be honest with you, that question, as reasonable as it sounds, is the wrong question entirely. Because while the XRP community has been staring at the ETF door, BlackRock quietly announced something that makes an ETF look like a rounding error. And the theory that is forming right now, when you connect the dots between Ripple, BlackRock, Chainlink, Hong Kong, and a $31 million institutional infrastructure bet, changes the entire picture. Let me pull back the curtain on this, because what I'm about to walk you through is not being discussed the way it should be. But before I get there, you need to understand something most analysts refuse to say out loud. Welcome back. Today we go deep on XRP. If this is the level of analysis you've been missing, you already know what to do. Let's start with what we actually know, not speculation. What is confirmed on the record from the mouths of the people running the largest financial institutions on the planet. BlackRock CFO Martin Small recently stated that BlackRock's iShares ETF products are moving toward tokenization within 3 to 12 months, not someday, not eventually. He put a timeline on it, and he clarified it could be 90 days, it could be a year, but the process has already started. And what are we talking about in terms of scale? BlackRock's ETF arm manages $5.5 trillion in global ETF assets. In the United States alone, that number is $3.6 trillion across 1,700 individual ETF products, stocks, bonds, gold, real estate, everything. Larry Fink has said repeatedly, every asset class is going to be tokenized. That is not a hypothesis. That is a stated corporate objective from the world's largest asset manager. Now here is where most people stop. They say, okay, BlackRock is tokenizing, maybe they use Ethereum, maybe Solana, let's move on. But that's where the real story begins. Because the question you have to ask is, which blockchain infrastructure is built to handle the settlement layer for something at that scale? And when you ask that question honestly, the answer keeps pointing back to the same place. Here is what we also know. BlackRock's Beudel fund, their tokenized money market fund, already crossed $1 billion in assets. That is their proof of concept. That is their trial run for moving real-world financial assets onto blockchain infrastructure. It worked. It is live. And now they scale. And when Brad Garlinghouse was asked directly about BlackRock launching an XRP product, he said, and I'm quoting, "We think it's inevitable for the XRP community overall." He didn't say no, he said inevitable. Larry Fink, when pressed on XRP in his interview with Charlie Gasparino, said nothing, deliberately. Two of the most powerful figures in global finance refuse to acknowledge each other publicly. Think about what that tells you. If there was nothing between them, they would simply say so. Silence from lawyers and executives at this level is not indifference. It is strategy. And when you see the actual numbers behind this, it becomes impossible to argue with. Now let's do the math, because the math here is the part that should stop you in your tracks. $3.6 trillion in US ETF assets, $5.5 trillion globally, 1,700 products to be tokenized. If BlackRock routes tokenized settlement through a handful of blockchains, and they've publicly said it will be a select group, even a 5% allocation to XRP ledger infrastructure represents $275 billion of real-world asset movement on-chain. Think about what that does to liquidity demand. XRP has a fixed supply of 100 billion tokens. Circulating supply sits around 57 billion. You are talking about a settlement network that would require deep, consistent liquidity at scale every single day. Not for retail speculation, for institutional settlement. Those are two completely different demand profiles, and this is the thing the retail crowd is not calculating. When institutions settle assets on a ledger, they are not buying XRP to hold it. They are using XRP as bridge liquidity, as the frictionless mechanism that moves value between tokenized products, across chains, across borders, in seconds. That is the use case XRP was engineered for, not as a store of value, as a utility layer for the largest liquidity flows on Earth. Cross-border payments alone run $150 trillion annually. Daily Forex volume is $7.5 trillion. The total derivatives market sits at $1.2 quadrillion. Even a fractional slice of that routing through XRP-powered settlement rails creates a demand equation that no analyst can responsibly ignore. This isn't a prediction. It's a design requirement, but math alone doesn't move markets. What moves markets is when the biggest players in the world start acting on that math. And that's exactly what's happening right now. Now let's talk about the people who are actually acting on this thesis with real capital. Ashish Birla spent over a decade inside Ripple. He helped scale it from the ground up. He moved to Ripple's board, and then he did something that tells you everything you need to know about where he thinks this goes. He left. He launched Evernorth, an active XRP treasury company, targeting an initial acquisition of over $1 billion in XRP with a planned NASDAQ listing. He didn't build a passive ETF. He built an active treasury that deploys XRP on-chain to generate yield and then reinvests that yield to buy more XRP. He called stablecoins on and off ramps, like broadband was for the internet. He said stablecoins are what make XRP's full utility accessible to institutions for the first time, and his backers include Ripple, Arrington Capital, and SBI Holdings. Ask yourself this brutal question. Does a man who spent 10+ years building something from the inside make a billion-dollar bet based on optimism? No. He makes it based on what he knows is already in motion. And he said something I want you to sit with. He said, "Technology alone is not enough. You need technology, then regulation, then capital formation." He said we have the first two, and the third is arriving now. That is not hype. That is sequencing. And he has seen this sequence from the inside. If you want this level of depth on every major XRP move, you know where the subscribe button is. No pressure. Now let's move to something that almost no one is connecting properly. Ripple and Chainlink, together in Hong Kong. The Hong Kong Monetary Authority ran its EHKD Phase 2 pilot. Phase 2, not a test, a live institutional pilot. Chainlink's CCIP, their cross-chain interoperability protocol, powered compliant cross-chain settlement in that pilot alongside ANZ, China Asset Management, and Fidelity International. And Ripple's role? Ripple joined the inaugural EHKD pilot with Fubon Bank to tokenize real estate assets using its CBDC platform on the XRP ledger. Same program, same regulatory umbrella, different but complementary infrastructure layers. Most people look at Chainlink and Ripple and ask who wins. That is the wrong framing entirely. The correct framing is who gets selected for the institutional interoperability layer. And what we are seeing in Hong Kong is that both Ripple and Chainlink are being selected, not instead of each other, alongside each other. You also saw Brad Garlinghouse and the CEO of Chainlink at multiple White House events over the last year, getting very close. In the background of the world's most consequential regulatory shift in financial technology, that is not coincidence. The institutions building this new financial system are not picking one blockchain. They are building interoperability bridges between the most credible ones. And XRP Ledger is inside that circle. A lot of people find this channel right before things start moving. If you're one of them, stay connected. So let me ask you directly. Do you think Ripple and BlackRock already have something in motion behind the scenes? Or do you think this is still early stage positioning? Drop it in the comments. One word is enough. Let's talk catalysts, because the timeline is no longer vague. The Genius Act has passed, establishing the regulatory foundation for stablecoins in the United States. Ashish Birla was clear. Regulation is what unlocks capital formation. And that first piece of regulation is now law. The Clarity Act is moving through government. If it passes, the risk premium that has kept institutional capital on the sidelines for years disappears almost immediately. The wait-and-see money becomes all-in money. And then there is this. Ripple Prime joined the DTCC's NSEC clearing system, the Depository Trust and Clearing Corporation. the backbone of U.S. securities settlement. Ripple is not knocking on the door of traditional finance anymore. They are being invited through the side entrance. At the same moment, the Federal Reserve's automated clearinghouse experienced downtime. Legacy is not failing gradually, it is failing in real time. And the institutions who understand this are not waiting for a press release. They are already building the replacement. BlackRock's CFO set the window at 3 to 12 months. That window has already started, and every week that passes inside that window is a week where positions are being taken by people who do not need this video to understand what is happening. But the window is not staying open forever, and that brings me to what I need to show you next. Here is something that most people in this space completely overlooked. Crossover Markets just closed a $31 million Series B financing round at a $200 million valuation. Crossover builds institutional-grade crypto ECN infrastructure, electronic communication networks, the same technology that powers Wall Street's fastest execution systems. Their co-investors include Tradeweb, Virtu, and Wintermute, and Ripple is at the table. Ripple co-signed this round. This is not a passive investment. This is Ripple buying a stake in the infrastructure layer that will connect institutional trading desks to the digital asset market. Ripple is not just building rails for payments anymore. They are investing in the entire execution ecosystem that institutions will use when they arrive at scale. Ask yourself, does a company that expects the future to be quiet and small invest in a $200 million institutional trading infrastructure firm? Or does a company that knows what is coming stake out its position in the plumbing before the flood arrives? The door is not wide open anymore. It is narrowing, and I know some of you are feeling the weight of that right now. So let's address it directly. I know some of you are watching red candles across global markets right now. Stock markets from Europe to Asia are seeing dramatic drops. People are nervous. That is real. I am not going to tell you it is not real. But here is what is also real. When equity markets drop, capital looks for alternatives. Gold is climbing, silver is climbing, and XRP volume is starting to turn up, not because of a tweet, but because the macro environment is forcing asset managers to look at what is liquid, fast, and decentralized. This is not the same dynamic as 2020 or 2022. In 2026, you have institutions with live products on blockchain, a DTCC integrated Ripple, the Genius Act signed into law, an active $1 billion XRP treasury run by a former Ripple board member, and BlackRock on a confirmed 3 to 12-month tokenization runway. The red candles in traditional markets are not a threat to this thesis. They are an accelerant. They are the thing that makes institutional decision-makers move faster, not slower, on digital infrastructure. While the masses are focused on the equity sell-off, the smart money is quietly loading the infrastructure that will replace it. Being early feels exactly like being wrong, right up until the moment the structure catches up. And that brings me to the most important thing I want to leave you with today, something I don't say lightly. The silence between Ripple and BlackRock is not neutral. It is not two companies that have nothing to say to each other. It is two companies that have been advised at the highest legal levels not to say anything publicly until the infrastructure is in place. Brad Garlinghouse will not confirm or deny BlackRock on Bloomberg. Larry Fink will not say XRP's name on Fox. Both of their legal teams are not protecting secrecy for the sake of it. They are protecting an arrangement that cannot be publicly disclosed until it is structurally ready. If you want to understand what is happening with XRP in 2026, stop looking at what they are saying. Start looking at what they are building. The Bweidel Fund is live on blockchain. Ripple is inside the DTCC. Chainlink and Ripple are operating together in Hong Kong. Ashish Birla left Ripple's board to build a $1 billion XRP treasury, and BlackRock just confirmed they are tokenizing $5.5 trillion in assets within the year. None of those things happened in isolation. None of them are coincidences. The architecture of a new financial system is being assembled in real time, and you are watching it happen before the general public has any idea what it means. History does not reward comfort. It rewards those who pay attention when the room is still quiet. I'll be breaking down the next phase of this in the next video. If you want to be there for it, You know what to do. Now I want to hear from you. Looking at everything we covered today, the BlackRock tokenization runway, the Burla signal, the Hong Kong convergence, what is the single development you are watching most closely right now? Tell me in the comments. I read everyone. Stay patient. Stay rational. The math doesn't lie, and the structure is almost complete.